When people talk about airport businesses in India, names like Adani and GMR usually come up. But there's another airport company that's quietly built on the strongest businesses in the industry, and it's still unlisted. We're talking about Cochin International Airport Limited, or CIAL. So what makes this company interesting for investors? Let's find out. First, let's look at the bigger picture. India's aviation industry is growing fast. According to IATA, India is expected to become world's third largest air passenger market 2030. But here's something many people don't know. Airports don't just make money from flights. They also earn from duty-free shops, restaurant, parkings, cargo, rental, and commercial spaces. That's exactly where CIAL stands out. CIAL has been operating Cochin International Airport since 1999. It was India's first airport built under the public-private partnership model and is also the world's first fully solar-powered airport. Generating its own electricity helps reduce operating costs, giving the company an edge over many other airport operators. The airport connects over 31 countries, works with 24 plus airlines, and handles more than 10 million passengers every year. It also serves Kerala's large NRI population traveling to and from Gulf countries, giving it a strong and consistent international passenger base. Now let's talk about the business. One of CIAL's biggest strength is that it doesn't depend on just one source of income. Around half of its revenue comes from airport operations like landing fees and passenger charges. The other half comes from the businesses like duty-free stores, cargo, rentals, and commercial spaces. For investors, that's a big positive because multiple revenue streams make the business more stable. The company has also expanded through subsidiaries in duty-free retail, aviation, services, and infrastructure, creating an additional growth opportunities. Now let's look at the numbers. As you can see on the screen, CIAL has reported strong growth over just last few years. The biggest jump came after COVID, as air travel recovered, but even after that, the company has continued to grow steadily. Its balance sheet has also become much stronger. The debt to equity ratio has reduced from 0.43 to just 0.16 in 3 years, showing that the company has significantly reduced its debt. Profitability has improved too. Its ROE is now close to 20%, ROCE is around 23%, and it reports an EBITDA margin of nearly 63%, one of the best among the airport operators. Simply put, CIAL isn't just growing, it's growing profitably. When compared with peers like GMR Airports and Kannur International Airport, CIAL may not be the biggest company, but it stands out for its efficiency. It has the highest operating margins, positive profits, and a much healthier balance sheet. Of course, there are risks. The company operates only one airport, so its business depends heavily on Cochin Airport. It also relies on traffic from Gulf countries, which means geopolitical events or economic slowdowns in that region can impact the passenger numbers. So where's the final takeaway? CIAL has built a business with multiple revenue streams, low debt, strong profitability, and a clear cost advantage through its solar-powered operations. For investors looking at the unlisted space, it's definitely a company worth tracking. And if it plans an IPO in the future, it could become interesting opportunities. But as always, the valuation will always be a key deciding factor. That's it for the analysis. Subscribe to SharesCard for more insights on unlisted companies before they hit the stock market.